As we look at inventory, one of the problems that we have to figure out is how do we allocate or divide the dollars of ending inventory and the items sold. Let's just take a look at this little situation here. We've got maybe like a farm equipment dealership, and they have a number of tractors available. They started with one tractor in their beginning inventory, and then throughout the year they purchased more tractors. So we have 6 tractors available for sale, at least over the course of the year. But notice the problem here. They each cost different amounts. And of course, I made it a nice hyperinflationary economy for us here. That's a little bit unrealistic, but it makes the numbers work out and easy to work with. So let's assume here that, as I put over here, during the year, we sold tractors 317, let me just mark this off here, 414, 518, and then what did I write down there? 618. So those 4 specific tractors were sold. And we can verify that. I'm sure they each have serial numbers. They're certainly valuable enough to warrant that. So the question is, out of these $102,000 that started out on the balance sheet in the inventory account, how many of those dollars should be released to the income statement as cost of goods sold? And how many of those dollars should stay on the balance sheet as ending inventory? We know that 4 of the tractors are cost of goods sold, and 2 of them are still in inventory at the end of the year, but it's the dollars that we have to worry about. Now, the specific identification method, and by the way, we're going to talk about 4 different methods. The specific identification method arguably is the most accurate method, because what we're going to do is we're going to say, and I didn't mention this, but these are the exact same model of tractor. I mean, if you looked at tractor 212 versus tractor 618, you wouldn't be able to tell the difference as long as you didn't look at the serial numbers. So these are identical. We just have differing costs. So the specific identification method, as I said, is arguably the most accurate, because what you're basically going to do is you're going to say, all right, let's add up the costs of the specific items that we sold, those 4 tractors, and if you do the math on that, you'll figure out your cost of goods sold is $68,500. And then the items we did not sell, right here, $15,500 and $18,000. If you add those together, you get $33,500. And we basically have the allocation between the income statement expense called cost of goods sold and the balance sheet asset, which is ending inventory. And you know, if you want to double check yourself, if you've watched any of my videos, you know I'm a huge fan of double checking yourself. In fact, if you're a student and you're taking an exam, a lot of times there are ways to double check and verify your own answer. You could almost grade your own exam before you leave the classroom. So let's take this cost of goods sold number, $68,500, add it to the ending inventory number, and a little bit of just this addition, that adds up to $102,000, which, no surprise, matches up with our total cost. Just as kind of an overall reminder, what we are doing with cost of goods available for sale, which is 6 tractors and $102,000, it doesn't make a difference which method you are using. Okay, I mean, the dollars will be different, but the concept right here is the same. You're essentially dividing those assets. So in other words, 4 tractors sold. You're dividing the assets and the dollars between the income statement and the balance sheet. So that's specific identification. Probably the most accurate method, because we're specifically grabbing the exact items that were sold, but hardly anybody uses it. And that's because it's a lot of work, a lot of record keeping. So specific identification probably only makes sense where we have relatively large value inventory items, maybe low turnover, we're not selling a lot of them, like tractors or a car dealership, maybe a jewelry store, something like that. but it's not going to make sense for Home Depot or Meijer or a lot of other businesses, quite frankly, that deal with inventory. So what we have to do is we need to look at 3 other methods that offer similar results, or at least they offer ways of making this estimate, but they each have their own individual compromises. So let's take a look at another one of those methods. So one of those alternatives to specific identification is FIFO, first in, first out. Now, this is a cost flow assumption. It doesn't mean that that is the exact order that we sold the particular assets, okay? So even though we sold number 317, 414, 518, and 618, these are the actual items we sold. What's going to happen for purposes of the dollars on the financial statements only is we're going to take the first 4 items and we are going to assign these to cost of goods sold. So our cost of goods sold, if you just add those numbers up, is going to be, what do I have on my sheet here? $65,500. Now, I just want to reiterate, those are not the actual items that sold. But remember, when we're not using specific identification, it's probably because we needed to make some kind of a compromise. We didn't want to go through all this additional record keeping. So what we want to do now is then say, all right, the items that remain, now I know that one of these really doesn't remain in inventory, but we're going to treat its cost as if it still were with us. Add those 2 up, and we get an ending inventory, $36,500. If you combine both of these together, that adds up to our $102,000 that we're trying to break up. So it's a cost flow assumption. It's a compromise. Let me just reiterate here. First in, first out. So the first item that was in is this one right here. Then the second one is here. The third one is here. The fourth one is over here. So you're going to fill your cost of goods sold with the oldest costs, and you're going to continue to fill them, getting to newer and newer costs until you've accommodated all the items that you sold. So what we basically do is check these off. Here's 1, 2, 3, 4. Cost of goods sold is finished. And really what happens then is you could either take these last 2 and add them up, assign them to cost of goods sold, or you could take the entire cost of goods available for sale, which is $102,000. You could subtract the cost of goods sold that you determined, and you would get to the same result, ending inventory. So that's another way of coming up with the ending inventory. It's also a terrific way to verify your work. Sometimes I even catch my own mistakes. Trust me, if you took a look at my notes here, you'll see those verifications. The last thing I would want to do is have a math error when I'm trying to show you guys how to do these things. Another one of these methods that we could use, and it's a compromise again, remember these are just cost flow assumptions, is LIFO. Last in, first out. And I got to tell you, when my daughter, she's almost 10 years old now, but when she was 3, I heard her say the word LIFO. I don't know where she heard that 4-letter word. I felt like it was almost a child abuser at this point. I mean, why should a 3-year-old be talking about accounting terms? So please don't turn me into the authorities. But we have to talk about LIFO. And really what I want to tell you about this is that LIFO, it's a little bit backwards. I mean, this probably is counterintuitive to you because it's last in, first out. We're still trying to assign a cost to 4 tractors, but we're going to start from the bottom. And we're going to take these most recent items in this order. 1, that's the last one we bought. Here's the second last. Here's the third. And then there's the fourth. So we're going to work up from the bottom. We're going to assign the newest items to cost of goods sold and then start to fill our cost of goods sold stack. So what ends up happening if you have a period of rising prices, so any kind of inflation, and I do know, I mean, these are hyperinflationary numbers. It's kind of like the cereal box where they have the big picture of the cornflake and it says enlarged to show texture. I mean, obviously, you know the cornflake is not this big. Same kind of thing. We would not expect prices to increase this much in the United States of America. However, I wanted to exaggerate it somewhat to illustrate the point that we're going to talk about right now. And that point is this, is that under LIFO, the most expensive things are going to get assigned to cost of goods sold if prices are rising, which over time, they generally do rise. So what you're going to see is when prices are increasing, LIFO gives us the biggest cost of goods sold. Now, it also gives us the lowest ending inventory. Even though we know that these two tractors, well, let me see. One of those tractors is still physically in inventory. This one is. But 317 was sold. It's gone. Okay? But even though 317 is gone, we're going to treat that as part of our ending inventory. Because these, again, are just cost flow assumptions. It's not what actually happened to the physical goods. You might be asking yourself, and as I do my little double check that you've become accustomed to right here, add those up, it's 102,000, just like you would expect right here. You might be asking yourself, why would we do this? I mean, first off, if LIFO gives us the biggest cost of goods sold when prices are rising, doesn't that also make us report a lower net income? And the answer is yes. So I'd like you to think about, is there any measurement of income where you would like a lower number over a smaller number? Obviously, for financial recording, you want to report the biggest profit you could, because then you can go to your investors and your bank and other people and you can say, look how well we're doing. What a wonderful job. But when it comes to giving this number to the IRS, you want the lowest number. Because the way the income tax formula works in the United States is you determine your taxable income and then you multiply it times the tax rate. Taxable income is the IRS equivalent of net income on an income statement. And there are tons of differences between the rules for measurement of income for federal income tax purposes and for financial accounting purposes. But as we focus on just this one item here, if you use LIFO for your income tax return and prices are increasing, you will get a bigger deduction than FIFO. Okay? That is what we're talking about here, is this allows companies to have a tax advantage. Now there is something called the LIFO conformity rule, which in technical terms means you can't have your cake and eat it too. I guess that wasn't so technical, but what I'm talking about is this. If you're going to use LIFO for income tax purposes, you also have to use it for financial statement purposes. So great, you want the tax deduction, the big tax deduction, you can have it as long as the IRS lets you use that method. But then you also have to use LIFO for your financial statements and report the lower net income. There's one more method we need to take a look at, and it might be my favorite. This last method is really the ultimate compromise because it requires some averaging. But I wasn't joking. I mean, I guess I don't have a favorite inventory method, but what I do like is the logic and simplicity to this one. Now, like any of these things, there are ways to make them more complicated. If you want to learn these complications, go enroll in an intermediate accounting course or an advanced accounting course, and we can discuss different nuances. But I just want to give you the basic weighted average right here. And all we're basically doing is we're saying, all right, you know what? There's $102,000 of cost. There are 6 units. $102,000 divided by 6 tractors gives you an average cost. What did I come up with? $17,000 per tractor. Okay? We're just averaging things out. You want to figure out your cost of goods sold? Well, we sold 4 tractors. The average cost was $17,000. That comes out to a total cost of $68,000. Your ending inventory? Got 2 tractors left on the parking lot. Average cost is 17 grand. The math isn't too difficult there. $34,000. And I guarantee you, if you add your cost of goods sold and your ending inventory, it'll still be $102,000. Okay? So the average cost method, now there are ways, like I said, to complicate it with kind of a perpetual rolling cost and whatnot, but this illustrates the point. Is basically saying, all right, we're gonna ultimately compromise, and we're gonna say the average tractor costs $17,000, and if we sell a tractor, the cost of goods sold will be $17,000. If it's still in inventory, we'll assume the cost is $17,000. Then we can finish our financial statements, and everybody's happy. We get to go home.